Hello, and welcome to another episode of Enter the Boardroom with Neural, the business podcast that brings the boardroom to you. I'm your host, Oliver Cummings, CEO of Neural, the board search specialist and market leader, bringing science to the art of board hiring. Before we get into the interview, I want to let you know about the Neural board community. One of my favourite elements is the Neural Mastermind, a safe haven for board members to discuss challenges and opportunities with peers. As an observer, I've been struck by how valuable it is to just listen to these discussions, which often make me more aware of my own blind spots as a board member. It was this realization that catalyzed the launch of the Neural Board Community Discussion Forum, where members can seek advice and share experiences on pressing challenges and opportunities openly or anonymously. I always loved the idea of being able to tap into the hive mind of the Neural board community and get its best thinking, of tapping into its network to open stubbornly closed doors. Well, now you can. Recent popular discussions include how to reconcile CEO board differences about a chair candidate. How do I manage conflicts of interest as I go plural? What can I do to get our new CEO up and running as quickly as possible? And how to be a good investor director. If you want to know what's top of mind for your board colleagues, or get help with a challenge you're wrestling with, or open a door for you or one of your boards at the click of a button, you can try the community for free for 30 days. As well as discussion threads, you'll benefit from smart online networking, one-to-one career guidance with our headhunters, third-party board roles, mastermind groups, and Q&As with senior board members. Head to community.neural.com to find out more. Today's guest, Paul Pester, has spent over 25 years building and leading some of the most disruptive and established consumer financial services businesses in the UK, Australia, and internationally. Paul is currently the chair of Tandem Bank, the fast-growing UK digital challenger bank, Ned at the National Bank of Bahrain, representing the Bahrain Sovereign Wealth Fund, Mumtalakat, co-founder and non-executive director at Archie, a fintech accelerator partner. Paul, a huge welcome and thanks so much for joining us today.
Thanks so much, Oliver. It's great to be here, of course.
Paul, you've experienced an incredible range of executive journeys, from being the CEO of the original challenger, Virgin Money, to the MD leading the roll-up of failing banks during the banking crisis at Santander, to the group CEO at TSB Banking Group, to the executive chair of your own fintech, Loop. Can we start with your time at Virgin Money? And I'm really interested to hear where you got most value from the board there.
If I think back that long ago, and bear in mind that is a long time ago, we're talking about the turn of the century, the year 2000, the board was amazing, actually. We had such a contrast. So at that point, Virgin Direct, as the business was called, before we relaunched it as Virgin Money, Virgin Direct was a joint venture between, obviously, the Virgin Group and a big Australian financial services business called AMP. And we actually had a rotating board position where we had two chairmen that would rotate between them. One was Richard Branson, incredible to have Richard Branson as a chairman, and the other was Sir Malcolm Bates. And unfortunately, we lost Sir Malcolm several years ago now, but he was the managing director at GEC under Lord Weinstock, and an industrialist in the sort of old style of a British manufacturing business. Working with Sir Malcolm on one hand and Sir Richard Branson on the other side was an incredible lesson for me. They were incredibly complementary, absolutely focused on the customer outcomes, what makes sense for a customer, why we are doing something better for the customer than our competitors are. And Sir Malcolm absolutely focused on the economics and how the business was running and how the whole thing was going to stack up. So that sort of yin and yang worked fantastically well for me.
The rotating chair concept, tell me more about that.
I think it was the way the joint venture agreement was written. Again, unusually, because each board meeting, it would be either AMP's turn to chair it or Virgin's turn to chair it. In addition to that rotating chair role, the AMP had two directors on the board, Virgin had two directors on the board, it was myself and the CFO, myself as the CEO and the CFO. And so in some respects, not uncommon to typical boards now in a privately held business, but the rotating chair, I think in some respects, as I say, it was incredibly helpful to have the complementary aspects of someone like a Sir Malcolm Bates and Richard Branson. But on the other hand, it did require the executive team to bring a level of consistency and a level of continuity between the various board meetings. They did tend to be quite different in their nature. If Richard turned up to chair one board, we knew exactly what the conversation was going to be about. If we were in AMP's offices and Sir Malcolm was chairing the board, it would be a very different sort of conversation. Both, actually, if I say it now, equally valuable, but just different. And I think that's an enormous lesson to me, certainly, in my first CEO job.
Where could it have added more value?
Really hard to say. Looking back, it seems a long time ago. Sometimes it did feel like There was frustration on, let's say, the AMP side when we were really addressing the concerns that Virgin had, and there was frustration on the Virgin side when we were really addressing the concerns that the AMP side had. And again, if I contrast this to roles I've played more recently, I think ensuring the board acts as an integrated team is really important. And I don't think there was any connection between Sir Malcolm and Richard outside the board meetings. Did they ever sit down and have a coffee and have a chat and talk about, okay, what collectively do we want from this business? Not really. If I, again, contrast that to the way I would fulfill my role now at Tandem, where I'm the chair, I absolutely see the importance of investing in having the board feel at least as a bit of a cohesive team. And I've seen that in subsequent roles where a really good chairman will work hard at bringing the board along with them and aligning the board around the focus of the business. Having your yin and yang of Sir Malcolm and Sir Richard is brilliant, but sometimes it would save a lot of hassle if they just had a chance to sit down and agree between them what they were looking for.
Do you think that was a misalignment of purpose ultimately? Or if you had been the SID on that board and looking to get the most out of two obvious talents, what could you have done, do you think, to have facilitated a better interaction?
I think I would hold some of it to myself as CEO. I didn't expect to be CEO of that business. I went there essentially to do some consulting work and suggested a new way forward for, as I say, what was Virgin Direct. And part of that way forward was changing the name to Virgin Money. And then suddenly I find myself as the person asked to lead the business as the CEO. What I think a CEO has to find a way of creating a common cause and a common purpose in the business. If I was to rewind and try to state it now, I would be saying something like, we're going to build an extremely valuable, challenging business by taking on the traditional banks and financial services businesses in the UK and give consumers a better deal. Why am I saying something like that? It's because the building a valuable and successful business is absolutely going to appeal to the Sir Malcolm Bates in this example, but by taking on the established banks that are failing consumers and giving them a better deal, it's absolutely going to appeal to the Richard and Virgin approach. So I think there was a common, we could have had a better common cause, a common purpose actually, and a more explicitly stated purpose than perhaps we had. As I say, looking back as my CEO, myself as my first CEO role, as I say to many people, I slightly cringe at the CEO I was. I was still very much an analytical ex-McKinsey consultant type, and the importance of purpose, the importance of having a cause for an organization, something that I was still learning as an individual. And I think a CEO has got a really important role to play when they engage with the board in reminding the board regularly and frequently and ad nauseum of that purpose. That's what drives the business. So yeah, we could have done that better. I certainly could have done that better.
Tell me a bit about your time at Santander, where you had a ringside seat during the banking crisis of some extraordinary events. What was the picture that you were seeing through the board there, and how did the board contribute to that experience?
Yeah, it was a fascinating time. And I joined, just for context, I joined Santander working for Antonio Horta, who was the UK CEO at the time, working for Antonio. And I joined in early September 2008. And we'll all remember, anyone who's worked in banking or financial services knows that date well. Within, I think I'd been there 2 weeks or something. And over a weekend, Bradford and Bingley was nationalised on a Saturday. The auction was run on a Sunday. We learnt, as the Santander team, from watching, the name will come to me, the BBC journalists on the 10 o'clock news on the Sunday evening announced that we had won the bid. And we heard it on the BBC before we were told officially, of course, and then took control of the business at 8 o'clock Monday morning. That was Bradford and Bingley that had failed, as I say. And so it was an incredible time, a very stressful time for customers, obviously, of banks. Obviously, we all know what happened at Northern Rock. Similar scenes were seen at Bradford and Bingley. We had just acquired Alliance and Leicester that was also having serious issues. If there was a common theme perhaps running through some of those banks that were failing at the time, in my opinion, and I know it's very easy for me to say from the position I had, which was rescuing or working with an organisation to rescue those banks, I think the boards obviously were not as close to the business model as perhaps they could have or should have been. I make no excuse at all for wanting to really understand the way the business works. When I took my role with the National Bank of Bahrain, and I am spending 10 hours a day in the office, and this is who I want to see. And so everybody from obviously the CEO, but including going into the operations center, including sitting in the call centers, including working in the branches, including talking to commercial customers. Why do I think that's absolutely vital that you do that as a non-exec? It is certainly not to become an executive, and it's certainly not to do the executive's job. It's to enable you as a non-executive to understand the business model and to use your experience to start identifying for yourself where you think the strengths, the weaknesses, and the risks are in that business model based on your experience. There's so little you can actually glean from a 2 or 3 hour board meeting, maybe once a month, once every other month. How on earth are you expected to genuinely understand the market in which that business functions and to understand, therefore, the challenges and the risks that they face? So similarly with Tandem, I'm in the office 2 or 3 days a week. I'm not getting under the CEO's feet, but I'm just trying to pick up how the business is functioning. And I think that's absolutely vital. And I think we're looking back to the banking crisis. There were times when perhaps the boards of those organizations were not as close to the real business model. And that's what I mean. I understand the business model and I understand the risks that they're running as opposed to genuinely trying to do the executive's job. Yeah, my obsession is absolutely around being close to the business and making sure that the board really understands that.
Which is music to my ears. I have a similar approach, and that probably comes from my private equity background, where I like to get into the atomic details, break things down, and then build them back up to be able to understand that big picture. What's always struck me as challenging in businesses like banks is the level of complexity. Like, it's one thing when you've got a widget manufacturer and you can get down into those unit economics, or you can drill down into the balance sheet and looking at the sort of the cash flows. I think in a bank that just becomes so complex and difficult with all the different subsidiaries. How far do you go? And for someone...
You've been listening to bankers too much, Oliver. Okay, let's stand back from a bank. And how does a bank fail? Fundamentally, there are 2 ways it can fail. It can fail very quickly or very slowly. How does it fail very slowly? Typically, it makes bad decisions on its lending, and therefore it thinks it's lending to someone who's going to pay that money back, and it puts a certain amount of capital aside for some bad debts, and then that loan could be a 30-year mortgage. Let's say, over a number of years, it starts becoming apparent that group of customers that you thought were going to pay you back actually are not paying you back, and therefore the amount of capital you've put aside is not enough, and that capital is starting to disappear. This happens to the co-op. It's a slow and painful death. The other way of dying is really quick, and it's liquidity. When suddenly everyone that's deposited their funds with the bank literally come on the same day and want to withdraw it, and you die within hours. Obviously, it's what happened to Northern Rock. It's what happened to Bradford Bingley. It's what happened very recently to Silicon Valley Bank. So as a board, it's fundamental to understand the likelihood of that happening. So again, if I contrast where we are, what I do with my board at Tandem, and I know if anyone from Tandem's listening to this, there'll be a wry smile on their face. I think that some of the exec team think I'm slightly nuts by insisting that the board understand the makeup of our deposits. And we have a long debate around, okay, all of those deposits that are above the FSCS limit, above £85,000, if this bank is in stress, what do we think is going to happen to them? Of course, the answer is they'll all go out the door immediately. But what's going to affect the behaviour of all of those balances less than £85,000? So maybe some customers that joined us when they've been with us for 3 or 4 years, and the interest rate we were paying when they joined wasn't particularly high. Maybe they're going to be a bit stickier. But those customers that have only been with us for 2 or 3 weeks, when we've had high rates, they're going to leave quickly. So what I'm trying to say is we focus on getting to the assumptions that are used to calculate the probability that under stress we see outflows from our business. That's what I mean about the board understanding the business and the business model. If we take it to a bigger bank, like a TSB, for instance, where we had a lot of current accounts that had been with the bank for 20 or 30 years, or we had some internet accounts that were very new, we had some time deposits, the board would work through a segmentation of all of those accounts, but have a proper debate, not the executive saying, here's the answer, but a general review on, okay, what would you do if you were a customer that had £200,000 in this bank and it was under stress? And so by forcing the board to work hard on the assumptions, it doesn't mean they then go through and they produce the detailed documentation, which is called an ILAP, which has to be submitted to the regulators. It doesn't mean they go through that, but it means they have had genuine input on the most, let's say the most important thing, the thing that can kill a bank quickest, which is the likely customer behavior that's going to lead to rapid deposit movement out of the bank. And you have a similar process on the capital position, which is basically calculating the ILAP or producing an ILAP. I insist on the board going through the assumptions of the ICAM with a smile on my face and no apology for it at the board, and what an explanation as to why we're doing it. It shows, first of all, that we understand the business. It forces us to understand the business, and it forces us to help the executive in really taking some very important decisions around key assumptions. So yeah, banks are big and complicated, but it does help to try and boil it down to, okay, what's going to kill me? And that's probably a good thing to focus on at the base level of any business.
You make it sound so simple. I guess what's surprising is when we have an organization like Silicon Valley Bank that gets something so simple wrong. How does that happen when you've got smart people around the table?
Many people are blaming the US regulators. They are blaming the US regulators because this process I described about you basically look at all your deposits and you do a segmented approach around the likelihood that those deposits will leave you under stress, and you build mitigating actions, this process called producing an ILAP. The US regulator said only really big banks have to do that. We don't think it's necessary for smaller banks to do it. We did not take that approach in the UK, by the way, which I think is the right thing. Every bank has to do it. And so people are saying the regulators are at fault because the regulators allow SVB to get away with not doing an ILAP. I passionately disagree with that assessment. I think it's common sense for the directors on the board to have to do that assessment. Deposit protection limit. So in the UK, above £85,000. If the bank is under stress because of faster payments, electronic payments, access to balances through your app, access to balances through a website, those balances will disappear instantaneously, particularly if your customers are commercial customers where they have an FD who has a fiduciary responsibility to move money from banks where the credit rating is reducing or there is seen to be risk in the bank. And so it absolutely felt like an accident waiting to happen. And again, I'm not meaning to, but I would say certainly to people listening to this podcast, if I was on that board, you'd have to ask those questions and you'd want to really get under the business. It's getting back to understanding what drives the business model. You talked, Oliver, about breaking the business down to an atomic level. People will constantly talk about connective tissue. I want to understand the connective tissue in the business. If the customer does something, how does that work its way through the business to impact our balance sheet and our P&L and our profitability, etc.? Driving through that connective tissue is vital. And I think, let's imagine you or me or anyone listening to this podcast would have got to a bank like Silicon Valley Bank and gone off and done their week's induction and forced themselves on the executive, even though the executive would have been probably pushing them away, screaming and kicking. Pretty quickly, they probably would have got to the conclusion that we have a really big concentration risk here, and what can we do about it?
Two recent guests come to me. Sir Richard Dearlove, who talked about his experience on the board of AIG being presented with a clean set of accounts 6 weeks before it imploded, and Roger Martin, who talked about the board of Enron, who had the world's leading authority, I think the Dean of Harvard, on its board, and who missed the financial accounting fraud. Two examples there of where executive teams have just pulled the wool over the eyes of the board. You make it sound simple with that. Make sure you understand the underwriting. Make sure you understand the liquidity risk. What is it that keeps you awake at night as a board member that you can't get your hands around?
The key phrase you use is pulling the wool over the eyes. And that is very difficult, if not impossible, if I'm honest, to guard against. I've been through exactly one of those experiences. When I was the CEO at TSB, we had a very large migration and the platform didn't work the way any of us expected it to work after the migration and the way that the data had shown it would work. We had data in front of us. This is how the platform should respond in these circumstances, and it wasn't. Ultimately, we got to the bottom of it and it turned out that the IT outsourcer had taken a shortcut to save themselves some money and literally not told that to the board. The data that was provided to the board was misleading. It led to that outsourcer paying £200 million in damages to TSB, but of course that took a while to happen. And by that time we'd gone through the hell on earth that was a bank not working post a migration. It is very difficult. My lessons from that sort of environment is to understand what I would almost call the sort of legal contracts that are in place, but also the cultural contracts that are in place. The cultural contracts and the personal motivations don't always align to the legal contracts. So back to my TSB example, legal contracts very clear. Tester will do this testing, report with this data. This is how the testing will be done. This is what the analysis should look like. And when it meets certain milestones, it will come to the board and will approve moving forward. The pressure on the testing team who were based in Spain to basically cut some corners was incredible and turned out to be more significant to them as individuals than the legal contracts. And so I think Whether it would apply to AIG and Enron, not sure, but normally in these circumstances where someone is pulling the wool over the eyes of the board, to use your phrase, there are personal benefits and motivations that are outweighing the legal contracts. Certainly for me as an individual, having been through that experience, I'm constantly, almost looking on a two-dimensional space now rather than a one-dimensional space. So if I understand all the legal contracts, I understand the penalties, I understand the obligations, blah, blah, blah. Yes, that's absolutely necessary. But let us now think consciously and hard about the social contracts and cultural contracts that are in place. Who has to benefit from this going a bad way? Who benefits from this not going the way we want it to? And I think that leads to an extra level of interrogation under these circumstances. So very hard to catch people who intentionally do bad things. But I think ultimately asking yourself who has what to gain from this is obviously one way around that.
Dambisa Moyo, another past guest, talked a lot about the importance of culture and boards' roles in setting the culture and a need for boards to do more. TSB was recognised as one of the Sunday Times top 5 best big companies to work for, so as independently vetted great culture. What have you learned from that experience, with that sort of juxtaposed against the experience you had with this, that helps you now in thinking about shaping the cultures of the boards that you're sitting on? What do you do to do that in practical terms?
I think it's the classic holding the management to account. The board talking specifically about values and culture. I think you're right. And if I think back to a particular example at TSB, when the business was up and running, we'd gone through the IPO, we were starting to grow the balance sheet, but we really needed a bit more scale to make the economics work. And at the time, Northern Rock was selling a £3.5 billion mortgage portfolio. And from an economics perspective, adding that to our balance sheet would absolutely have transformed us. And the board, I was very impressed with the board at the time because they, of course, understood the economic benefit of having those extra £3.5 billion worth of mortgages, but they were very focused on, okay, how are we going to treat the customers? We treat TSB customers in a certain way. When, for instance, when you had a mortgage product with us, as we bring out better rates, we make you aware of them. Many of the customers that were in that Northern Rock book have been trapped on rates and they had nowhere to go because they had quite high loan to values. And the board spent a lot of time challenging the executive on how are you going to deliver the same values and experience to those customers as you're going to deliver, as you do deliver to the existing TSB customers. And in the end, we did exactly that. It did affect the economics of the business because we saw some higher churn out of the higher margin products, but I think was exactly the right thing. And I think is an example of good behavior where the board holds the executive to account, not only in the economics and the strategy of the business, but they understand the implications of holding the board to account when it comes to the values and the behaviors as well. You can't have one without the other. You can't choose when I'm going to live the values. Ideally, as a CEO, an executive team or a board.
That's interesting because I guess one view would be to say your chance as a board member to influence the values are the point when you appoint the CEO, because they are ultimately going to set it. But actually, I think what you're saying there is that it goes beyond that, and when you are monitoring, holding them to account, you have multiple opportunities to keep bringing it back to how does this live with these values that we said we're going to live by. Are there sort of particular forums or moments in time in the board when you think that's most effective, or is it a continuous discussion in your mind?
The times I can think in my mind that it seems most important is when there seem to be relatively big decisions or significant decisions to take. An acquisition, for instance, how we're going to treat the customers as part of this acquisition. Therefore, what's the cost? What's the economic impact? Another example comes to mind when, we were growing our credit card business. I was absolutely against long interest-free balance transfer periods because I knew from my own experience that people didn't understand them. And if you took 18-month or however long they got it to be 36 months interest-free period on your balance transfer, the chances are as a customer, you're going to trip up at some point and you're going to pay through the nose for it. And so we intentionally never issued those products to customers. And that little debate would come up every now and then as we were looking at our strategy and as we were looking at how to drive the economic performance of the business. And I think therefore tends to be the key point for a non-exec to be able to make those calls is when it comes to a decision around business strategy, a business plan, a medium-term plan, plan, how are we going to drive the performance? And again, I believe a strong values in the brand actually helps the economic performance of the business. And why am I saying that? Why, when we, again, back to the TSB example, and we can talk about Tandem as well, local banking for Britain and the positioning of helping local people help themselves, that was designed to enable us to attract low cost deposits. How do you make money out of a bank? The lending side of your balance sheet, the rates you can charge are typically set by the market. Most of the market is through intermediaries or through brokers or through some third party. It's very hard to influence it. And therefore, the way you influence the margin is to adjust the amount you have to pay for your deposits, and the net interest margin is the difference between them, of course. The belief and the purpose that TSB told us that the strong brand positioning and the strong values, including making our employees partners in the business, would enable us to have a lower cost of funds, which would enable us to have a stronger NIM. And so we grew the balance sheet from 18 billion to 32 billion, keeping a NIM at 3%, which was really high. Fast forward to Tandem, helping mainstream consumers transition to a low carbon lifestyle and save some money along the way. We're very focused on delivering a brand experience to our customers and helping our customers understand how they can reduce their carbon footprint. We've got some great things in the app where you can put a postcode into the app and it will give you your EPC rating for your home, and it will then suggest to you the next steps you can take specifically for your house to improve its carbon footprint. Those sorts of services enable us to continue to offer good rates on our savings, but not have to offer the very best rates in the market. And so by building a brand and building a set of values, it enables a business to maintain, certainly in a bank, maintain its margins and to actually be more financially successful. Standing back and reminding yourself of that in the middle of taking all these decisions and saying, if we go off and launch this credit card, maybe it'll give us a bit of an income kick for a few months, but fundamentally it's going to destroy brand equity. This, again, back to my Virgin days, we always had the concept of paying into the brand bank and then withdrawing from the brand bank. It's always important to keep that brand popped up by reminding customers why what we were doing was in their interest and would benefit them all the time.
Listening to you talk there, that sounds very much art versus science. Was there a quantitative framework that you used for thinking about that?
Yes, and there is. There is with Tandem, there is with TSB, less refined, I think, to be honest, at Virgin. But it's back to really understanding the economic drivers of the business. I would expect the non-execs on our Tandem board to be obsessing around the cost of funds and to be obsessing around our ability to see other competitors in the market come in at a higher rate for a 1-year fixed rate, 2-year fixed rate, higher rate for an instant access savings, but understand how we're able to retain our deposits and the impact that has on our profitability. It is difficult because fundamentally you're trying to test the price elasticity on many of these variables, and it's really hard to get there. But I think it's certainly, in my experience, a brand experience delivered well pays into the brand bank and enables you, therefore, to maintain a differential in pricing that is not otherwise possible. I would probably go as far as saying there are many financial services brands in the UK, to be honest. There's some very well-known names, but there's not many brands. And obviously by brand, I mean, what emotional reaction do you engage from a customer when you talk about that business or you talk about that brand? Very few of those, and building one has immense value to it because it enables you to reduce your customer acquisition costs, reduce your customer retention cost, and therefore drive more profitability through the business ultimately.
So that makes sense to me, but it requires a leap of faith from your board to do that. You've got the hypothesis that building that brand will result in a lower cost of funding, but it's a long lead time before that comes through. So how do you said earlier on that you're very scientific and data driven in the way that you go about it? Where's your data supporting that?
It is possible to build early indicators. So again, thinking back to Tandem example, the extent to which we are getting customers really engaging with the Green Hub on the app, the extent to which we're having to, every time we are running a campaign or a promotion, where are we on the best buy tables? Are we number 3, 4, 5, 6? Down to number 10, how much volume are we seeing from this campaign versus a volume from a different campaign? So building that cohort by cohort, campaign by campaign analysis, having the ability to track customer behaviors by cohort, not only in the volume of deposits, but the level of engagement we get from that customer, the number of times they're logging into the app, what they're looking at on the app. That integrated view of customer cohorts is absolutely vital because early on book performance from the customers certainly shows when things are not working. And it's one of those iterations of constantly trying to improve. It's something we did even right back in, and if I think of Loop, which was a startup that I was leading, one thing we built from the very beginning was an obsession around being able to look at individual cohorts of customers and be able to run campaigns through different channels with different creatives and be able to follow the behavior of those customers. And seeing the depressing stats when campaigns are not working is a great motivation to suddenly try and find one that does work, and then finding something that does work and then doubling up on those campaigns. So I think it, as ever, coming down to the right MI is why it says I'm really right into the nits and grits, but fundamentally getting to the right data and the right MI, the right insights. It always amazes me how big businesses look at sort of large groups of data, amorphous data, rather than individual data. Again, if I flip around a little bit, I remember when I joined Lloyds TSB straight after Virgin Money. I've been at Virgin Money as the CEO there for 6 years and then went in to run retail consumer banking rather at Lloyds TSB. And we felt we had a great current account business. We were the biggest current account business provider in the UK, and everyone looked at market share and said, it's fantastic. We've got 23% market share, and isn't that great? Until you ask the question, what's our share of flow versus our share of stock? In other words, of all the customers who were open to current account this month, how many did we get? And our share of flow was down in single digit. Our share of stock was at 25%. And then you say, why are customers leaving us? Biggest source of customers leaving us was unfortunately death of our customer base. Our customer base was moving along and getting older and older. And if you look at the sort of cumulative amount of data, business is enormous. We've got 20-something% market share. If you look at it on a cohort basis, we're actually failing in our younger cohorts because we have a very nice big sort of legacy book that we're sitting on. Getting the right data, I think, is vital, and being incredibly inquisitive. And to your point, Oliver, about breaking the business down to the component parts to its atomic level, or in my language, like understanding the connective tissue of the business is absolutely vital. And I really think it's important for NEDs to do that, non-exec directors. That most non-exec directors will have had a really successful executive career. They'll know all this stuff from their executive days, wherever they've worked, whether they've worked in operations or they've worked in strategy or they've worked in pricing or they're CFO or they've been the CEO. They'll know these things. And I think it's vital to bring that mindset into the boardroom and not to be apologetic for making, that's what you bring, your experience, and not to be apologetic for asking those questions. You're potentially helping the executive see something they may not have seen otherwise.
You took on your first non-executive role whilst you were still in a CEO role, a characteristic which is common to the highest performing CEOs according to research. Was that a conscious strategy of yours at the time?
It was, actually, looking back, and I'm an enormous advocate of it. It changed my way of fulfilling my executive role completely. So this was Micro Focus International, who at the time were the biggest listed software business in the UK, and suddenly being plunged into a boardroom where you get the board papers a few days before the board meeting. Suddenly you're meant to be able to add some value. It changed the way I did my executive role or fulfilled my executive role. It changed the way that I engaged with the board, understanding the difficulty of fulfilling a board role and fulfilling it effectively. It made me, instead of just looking at the board as being unfair, but being at times a bit of an irritant if you're an exec, getting in the way, making you write papers, it made me realize this cohort of this team of individuals can add a tremendous amount. And it's my responsibility as an executive to provide them the information in a way that they can digest that can make them effective. And I think that flipping of the responsibility, a big part of that came from doing a non-exec role. It's to reiterate, it is too easy for an exec to say, I've written what I think and that's it. It's up to the board to decide. And, an executive, I think, have an obligation of trying to put themselves into the non-exec role and providing information in a way which is meaningful and useful to them. So I'm an absolutely strong advocate of exec team members taking on non-exec roles. After we'd listed TSB and we got through the challenges of listing it, my HR director was a non-executive director at the Open University. My COO was a non-executive director in a big manufacturing business. And so they were learning. So I think it's very important for CEOs and actually senior executives in businesses to do a non-exec role if they can.
It sounds like, if I play that back, you shifted your emphasis in the way that you looked at the board as a CEO from their role as a monitoring function who were there to check your homework to their role as an advisory function who were there to help you get better. Was that the fundamental sort of mindset shift, or was it more than that?
Yes, fundamentally. I think it really crystallized my view. If you ask the board, what is it meant to do? instructions. There's the Companies Act, there's the UK Corporate Governance Code. If you're regulated, there's the FCA conduct rules, there's the PRA fundamental rules, there's the Articles of Association, there's a shareholder agreement, and there's numerous articles written on how a board should function. I find myself, I think, in typical pyramidic way, a board can function at 3 levels. At its very base level, let's call it level 1, a board is there basically to satisfy the regulatory requirements. So it's a little bit of a tick box exercise, let's say that. So level 1 is I meet the requirements of the Companies Act. I meet the requirements as they're written down in the FCA Code of Conduct. Maybe level 2, as a board, I can use my experience and my insight and my knowledge to hold the directors to account, the executives to account. We've talked a little bit about that in terms of enforced values of a business. So I can question them, challenge them, make sure they're thinking about this. But I think the board really adds value when it gets to its level 3. And at level 3, the board alongside the executive are entrepreneurial leaders of the business. I talked about this to several boards, and it sometimes is a slightly sort of strange look of entrepreneurial leaders of a business. How can a board be that? I think that is the exact words, though, that are used in the UK Corporate Governance Code, strangely enough. And how do you enable a board to, of course, fulfill its level 1 responsibilities? It has to, of course, to fulfill its level 2 responsibilities, but more importantly, to spend as much time as possible in level 3, where the board, together with the exec team, are really being entrepreneurial leaders. And I think the way the executive provide information to the board, the way the executive engage with the board, absolutely influences the board's ability to get to level 3. But I think making sure that the executive are presenting their insights, the data, in a way that enables the board to get up to level 3 and focus on the entrepreneurial leadership is key. And that's what I learned as being a non-exec myself. I hated the fact that badly prepared boards and badly prepared papers mean the board really never gets it on. It fulfills its statutory responsibility, but it doesn't really add value to the business by progressing to level 3. And so I think the more that executives can fulfill non-executive roles, the better functioning the board is, basically, completely.
Paul, time has flown by, which means it's time for the lightning round, where I'm going to say a short statement and ask you for a quick response if you're ready.
Oh no. Okay.
Best book every board member should read?
Please Understand Me. I think it's David Keirsey.
Most valuable board ritual?
I think the pre-board coffee and chat with the rest of the directors. It's really hard getting the board together. Often they don't meet that often, and therefore having a social relationship with board members, I think, is key. So that's often underinvested in, but I think it's very important.
Most significant professional insight?
In God we trust, everyone else brings data.
Worst professional advice you've ever received?
Oh, God. Believe it or not, I do remember my PE teacher telling me you should be a PE teacher. Maybe that would have been a good thing to do, I don't know. But I came very close to following it at some point. I did a lot of sports, a lot of swimming, a lot of stuff when I was a teenager. To someone with a hammer, everything looks like a nail. And obviously to the PE teacher, I looked like a great PE teacher. So I'm glad I didn't end up doing that. Went off to be a physicist instead.
What have you changed your mind on about boards over time?
Probably how easy it is to be an effective non-exec director. That's the point about being a non-exec. When you're executive, doing both roles simultaneously, it really realised actually how hard it is to be an effective non-executive director. So the slightly flippant view of boards early in my career, I think, has definitely changed.
When was the last time you got a significant judgment call wrong in the boardroom, and what did you learn?
Since in God we trust and everyone else brings data, judgments don't have on that. They're normally data driven, but I can remember a very specific case way back at Virgin Money. We had built, as well as launching our own Virgin products, Virgin Credit Card, Virgin Savings, etc., we had built what was effectively a price comparison website to enable customers to compare the market and then choose our products. And we really struggled to get customer engagement with it. And we ended up pulling the plug. Simon Nixon had listed Money Supermarket for £600 million, and the price comparison website had taken off. And the number of times I've looked back thinking, how did we get that wrong? I think we jumped too soon, definitely.
How are you better today as a board member than when you started?
I think you'd have to ask the rest of the board whether I am or not. I think it's more, I invest a lot more in the relationships than I would have done in the very early days. Understanding that a team is really important. And so I think whilst I'm more naturally a sort of analytical type thinker, actually the investing in the relationships around the board table is really important to me.
And lastly, 3 things listeners should take away from this podcast if they take nothing else.
Absolutely understand the business in which you're working with. If any listeners have made it all the way through this, they will see a theme of the importance of understanding the connective tissue and how the business you're working with functions. Get out and visit the operations sites, get out and talk to customers, get out and really understand your competitors, understand the business, not so that you can do the executive's job, but so that you can actually add value in the boardroom would be my number 1. My number 2 would be focus on trying to get to level 3 in the boardroom as best you can. from the sort of statutory responsibility to holding the board to effect and actually being entrepreneurial problem, and legitimize a conversation about where the board is functioning. Are we in level 1 on this problem? How do we get to level 3? Make that, verbalize that around the board table and engage directors on being in that level 3. And then thirdly, probably work on the personal relationships. Boards are very strange creatures in the sense they don't get together very often, but when they do get together, they sometimes have to take very difficult decisions under very pressurized circumstances. And at that point, as human beings, we do rely on personal relationships. We rely on just understanding people's body language, rely on understanding individuals as people. And so invest in the relationships around the board table.
Well, you have covered an extraordinary breadth and depth. That has been such a treat. Thank you so much for taking the time to share your experience and wisdom.
Great. Thanks, Oliver. Speak again soon.
If you found this conversation interesting and would like to be involved in similar discussions, join the New Role Board community. Community membership gives you access to 24-hour discussion threads on boardroom challenges and opportunities like those we've been discussing, smart online networking events, one-to-one career sessions with our headhunters, third-party board roles, mastermind groups, and Q&As with senior board members. Head to community.newrole.com to find out more.